Hey guys, so Sean from Invest to Live here. Listen, let's talk. This has been some pretty crazy times in the world of crypto. This channel is not purely about crypto. It's really about investing in all kinds of asset classes, locales, time periods, different ways to look at and manage your own money. But I think it really is definitely due to have a conversation here, understand a little bit more about what's going on, what's driving things. But also, I think that what really hasn't been addressed is this idea of like, well, how leverage is being used, why people are using it, the risks it obviously has, which we are witnessing in real time here. But also, what I'm really curious about is, do people really understand how to research what's going on in this space? We talk about it all the time from an equities perspective. We have lots of analysts who are on YouTube talking about how they look at and understand stock prices, movements, technical analysis, fundamental analysis, retracements, etc. Um, but on-chain analysis is a very different thing. And I think that we have people who are taking massive positions, highly leveraged. And I do wonder how many understand the risk, how to stop that risk from happening, and what kind of analysis they're doing. So before I jump in, as always, if you're not subscribed, please hit that subscribe button. We really appreciate it. And at the time of this video, we're inching our way towards 1,000 subs, which is frankly amazing. I can't honestly believe it. And hit the like button if you think there's value here, and I hope there is. And if not, let me know why you don't think so. So I'll kick it off, right? I obviously have a little bit of my joke here on my HODL hat that I like to wear once in a while, but not just with crypto. I treat really my entire portfolio this way. I think that the longer I can hold things, I get tax advantage approach to it. I typically see that markets ebb and flow over 20 years being in this space. So just in general, my natural nature is to try to hold long term, grow steadily, add to my positions, look to double down where it makes sense, look to dollar cost average where it makes sense. But with crypto especially, I think this is such a new market. It's such a new technology. Even after now over a decade of having it out there, mass adoption, understanding, et cetera, is just not in place yet. So let's jump in quickly on a couple of things that are happening in the sort of crypto world right now. And I want to give some thoughts on that and some areas that I'm thinking about. As always, I don't edit these videos, so I'm just going to come at you with a little bit of a brain dump here. So here's the deal. We have seen just a massive downward spike in pricing across crypto, really across the board, frankly. I originally got into this space in like the 2015-ish time frame, 2016. I was mining a little bit, still have some of the equipment set up behind me here, but it just doesn't run. And I can remember watching the price go from $300, $400, $500 for an entire Bitcoin to suddenly, like, it felt like a blink of an eye, and it was up to 16, 17, 18, 19, just about 20, and then completely came all the way down. And at that time, it was sort of the same conversations we're hearing today. It was, it's going to be banned. It's a huge problem. There's the energy usage, et cetera, et cetera. And I think that much like the news stories we're hearing today, and I want to be clear here, I'm not suggesting you should buy crypto, own crypto, leverage crypto. I'm not saying that you shouldn't either. I'm just looking at this purely from a time frame perspective, how I look at it, and just some extra pieces that I think often get ignored here. And I think that as I'm thinking through this too, there's both a need to understand what technical analysis looks like. This is not just chart reading, by the way. This is like on-chain analysis. This is the stuff that you have to become good at if you're going to put real big amounts of money, and especially if you're going to leverage, which I absolutely don't think you should. But just for the record, you really should be thinking about that. I can remember back in 2017, 18, things are going completely down. Everyone's, get out, it's terrible, it's never going to work. I'm a tech guy by nature, live and breathe in data and analytics, machine learning, AI, et cetera. So blockchains are a really big thing for me. I started loving the idea of it and what it was. So for me, it's less about the crypto and more about the blockchain. Of course, the crypto sits on top of that, and that's how we, motivate, monetize, et cetera. So, by its very nature, I like the idea of what it is. But during those times, there wasn't as much opportunity to have leverage positions. There wasn't the kind of institutional acceptance we see today. But we're still getting the pushback. China is going to ban it. China's going to restrict it. The U.S. is going to restrict it and tax it, et cetera, et cetera. Look, let's get one thing out right away. Just pay taxes on the crypto, right? Who cares? If you're making 100, 200, 300, 400% gains, or potentially way more, just pay taxes on it. It's not worth getting in trouble. It's not worth going crazy about it. It's not worth having panic about it every time this news comes up. It's an asset class. It's going to be taxed at some point. Make sure you're prepared to do so, and track when you buy and hold. And, just remember, like anything, you ultimately are going to get taxed on it when you sell it. So if you buy and sell in short-term periods, you're going to pay more. If you hold long-term, you don't have to get that capital gains hit. So just think about that too as you're going into it. So let's fast forward a little bit. In those early days when I was getting involved, and granted, those weren't the super early days, but just going back a few years now, I think what's really different this time around that everyone's talking about, so there's nothing new here you haven't heard before, but I think what's really different is it's become a little bit of like a celebrity issue. We see our tweets come out from certain people in the space. We know there's some institutional buyers. We also know that banks flip-flop all the time. You have to know that going into this. One minute they're selling to all their institutional accredited class investors, and the very next they are breaking news that they don't like it anymore for these reasons that have existed for 10 years. Listen, it's a media play. Don't fall into those traps, but also be aware, like when you see these massive movements of pricing, it takes more than one person saying something or one person selling or some small position being moved. I think you have to really understand that this kind of like widespread dump in price is because things are getting blown up in the back end. And I'll explain what I think about that in a second, or what that means to me. One really big notion here as well is that we have been here before. I'm not saying you shouldn't worry or that you should get in, as always, right? I want you to do your own work and your own research. But I see crashes like this personally as a long-term investor of over 20 years in many different kinds of markets, from currency to equities to real estate and to crypto too. And I don't stress these things, right? I don't stay up at night wondering what's going to happen the next day. I don't panic over it. Across many of the videos I put on YouTube, we talk all the time about downside risk. We talk about hedging. We talk about why you have to do those things. You have to know those things. You have to know what can happen if X or Y or Z goes down, what the impact on price will be. The good news here is because there are long-term charts, especially against Bitcoin as sort of a proxy for the space, we know when things crashed back in the day, what that looked like and how long it took. We know back in 2017 what happened and what that looked like. We know we can look at what's going on now and start to get a feel for what the probabilities or likelihoods of a reversal might be. We can start to get a feel for how low we're going. We can start to get an understanding of why it's happening. So let's start there. Let's get back to the current day today. We know that there were many people heavily leveraged. Sometimes I'm hearing like numbers like 20 to 1, maybe even more leverage on crypto. Listen, leverage is risky in the stock market, let alone at a 20 to 1 in crypto. Just to give you some correlation here, that this is not unprecedented, by the way, but why we have to think about it. I'm failing to think of the exact date and time. It must have been early 2000s, the Forex space as an example, or maybe even a little bit later than that. The Forex space was somewhere around 200 to 250 to 1, depending on the markets where in the world you were located. But I can even remember in the US, when I first got into the currency arbitrage and looking for those opportunities, we were trading at a 200 to 1 leverage. And even at the time, I remember thinking like, I'm a person who's very conservative in downside risk. I'm looking for that protection. I'm looking to leverage hedging as much as possible. And even for me, 200 to 1, I was like, man, there's going to be a lot of people who get blown up. And of course, in those markets, we saw this happen. We started happening in a big way. Major, well-known asset advisors went down fast. They went down hard. And a lot of people went with it. And that was really where I doubled down on my understanding of both why and how I have to protect myself, and understanding how to actually take some degree of profit on that protection as well. And I think when I heard those numbers of like the 20 to 1, sure, it's not a 200 to 1, but 20 to 1 is a big amount of money, and it sounds like, hey, I'm going to go get my Lambo, I'm going to get my mansion and take my vacations. It's not happening. I'm sorry. Like, yeah, there's a rando case here and there where someone made a 2,000% return. It was all on leverage. Sure, 100%. But as we just saw in this recent turnaround, people who are leveraged are getting blown up left and right. And we're hearing a lot of what I would say is just general FUD in the markets. Like, this is because of China. This is because of Biden. This is because of taxes. What I heard and what I'm seeing in the back end here is that something like 800,000 wallets got blown up that were on leverage. That's not a couple of big whales. That's 800,000 individual wallets that were highly leveraged and then blew up and ultimately got liquidated. When those get liquidated, that money is going somewhere else. So someone's picking those up. They're being allocated somewhere else. What we also saw a lot of was that money was coming on and off chain, or on and off platform, I should say. The reason this is particularly important is it wasn't long-term holders of coins. There was relatively new coins that were bought at relatively high-ish prices based on current markets. So again, it's folks who jumped in, tried to play the game, try to put some leverage on it. And what it looked like was they got bumped out of the market. the numbers got crushed. They had to get out of it. What I think is important to understand here is that if your only approach to understanding risk within the blockchain world, especially as it pertains to Bitcoin, is you could be missing a lot of the forest for the trees and understanding what's there. I often hear this notion, and I'm smiling because of how silly it seems even when I say it out loud, that, cryptocurrency is like for the criminal underground because it's all hidden. That could not be further from the truth. All hidden. I mean, you can track every transaction in real time as it happens, where the wallets are. You can understand pricing, how much was moved and where. I'm not saying there's not ways around anything, but just for the record, this is a pretty transparent system with an open system of tracking transactions. I mean, this isn't some dark pool being leveraged by two hedge funds where no one even knows anything happened until months later when it gets reported on a form. So this is real-time information that you can actively go and track. You can actively see what's going on. And you can start to understand what that profile looks like that's making these moves. So the notion that this was just a bunch of whales who dumped all at once, I don't know. I don't think personally that that's what happened here at all. And the other piece of it as well, I just want to talk about this China FUD before I talk about some of these on-chain data points I'm seeing. Michael Saylor of MicroStrategy actually beat me to this, which is great because it only sort of emboldens me to feel like I have the right idea here. Is, in one motion, we hear Elon coming out and saying, hey, this space is not green enough. It's way too much energy consumption. We're not going to accept Bitcoin anymore at Tesla. That was an initial hit. I don't think that caused a majority of what happened from the pricing perspective, but it was still an important indicator or a data point that we should be paying attention to, if nothing else. Now, we know that Cathie Wood of ARK and other CEOs of miners immediately came out and said, we don't agree. We know that 75% or so of major mining companies are looking or trying to use more and more green sources of energy, right? Hydrothermal, solar power, wind power, et cetera, all these things. Where Michael Saylor had a great point, I don't know if it was earlier today or yesterday, but he said, hey, look, if China's going to crack down on mining, if nothing else, that almost in a way solves for some of these issues with being so energy dependent. A lot of the Chinese miners, as we understand it, are leveraging traditional power sources. These are the areas that a lot of people are focused on as being the negative areas. By bringing those mining capabilities to other countries that have more green approaches or more availability to green energy, you sort of, in essence, China shutting down miners actually helps the entire network from the standpoint of being more green, a better approach to how they do it and what that's going to look like. So like the more we like react to the initial 5 seconds of what the news says without taking a step back as professional investors and really understanding what it's doing to our portfolios, what it means in a big picture, like stop trading, like set your stops, set your downside protection, and then read into things. If we react to every tweet or every 5 seconds of news that comes out, it's going to be impossible to make money long term. And that's the goal of investing. So let's touch on a couple things as well. When we're thinking about the kind of information that you can get by looking at a blockchain, and I'm talking about Bitcoin specifically here, but just for the record, we're looking at things like general blockchain information around Bitcoin, like historical prices, what blocks have been mined recently, what kind of mempools we have, what kind of dates. So like as an example, right now it's 1:57 p.m. on the East Coast in the US on, I literally had to look at my calendar, May 23rd. Right now, the current price as I'm recording this is 33,176.06. We have an estimated hash rate of 2.49. We have had over, looks like 5470 transactions in the past 24 hours. The transaction volume is 78,489 Bitcoin. Now, the price has been variable quite a bit. We've seen it dip and move way more than normal. In the past 24 hours or so, we're seeing highs in just under 40, call it about 38, 39, lows down below 32, somewhere around 31. We're seeing the general unconfirmed transactions by bytes, somewhere as high as like the 88 million range, all the way down to right now at almost a lowest point of, just above 65 million or so, right? We're seeing lots of blocks coming in from Antpool, F2F Pool, via BTC. We see some really big transactions happening here. Rather than share all this information on my screen that's in data that's going to be boring to look at, I'm going to read it real quick. As I see, the last 5 transactions are for 94,000, 2,000, $100, $27, 360, and then one big one before all that for almost 250K, right? So about 7.5 Bitcoin. So we're seeing transactions happening, excuse me, allergies in the Northeast here. So we're seeing all this information. It's all available. We can even start to get into understanding like how many daily active addresses do we have out there, but not just, how many are active, how many are new, how many are zero balances, how many are actively moving in and out. We also track things like total addresses with balances and how that's grown. So just as an example, from Jan to probably last week or so, we went pretty much straight up, right? We saw some dips, but we're starting to rise again. We can also see that the number of large transactions as it stands right now in real time is at a low for the most recent couple of weeks here. We look at things like, from an ownership perspective, how long have people been holding the coins? Are they hodlers? Are they traders? Are they just sort of keeping it somewhere but have had it for a little bit of time? We can look and understand things like concentration. How much of the volume that we're seeing are standard investors, right? Versus whales versus retail volume. You might say, well, how do you define that? I'm going to read it to you here. A whale is an address that owns more than 1% of the circulating supply. An investor is what we would typically think is an address that owns between 0.1 and 1% of the circulating supply. And a retail trader is anything less than that 0.1. So there is a lot of data in the blockchain that you can leverage, you can use, you can build your thesis around and how you want to go to market around this holding. So the reason I'm saying all this today is we need to be smart investors. You don't have to listen to the FUD and take it at its surface value. That doesn't mean you don't sell. Maybe you believe that that is a good reason to sell. That's great. Maybe you believe it's a reason to go double down and buy even more. That's great too. But do the research, please. We talk about this all the time. You have to look at the big picture of what you're investing in, what the upsides, downsides look like, what we've seen historically. Not that it's always an indicator of future value or future perspective, but at least it gives you something to look at and compare to. If we see lots of new wallets opening up because these prices come down, maybe that's a sign of new money pumping into the system. If we see huge amounts of coins coming back on platform, maybe that's a sign that people are trying to sell out of the position, right? These are the things we need to learn to be successful and professional investors in different asset classes. We can't approach every new asset class the same way that we approach another one or a different one, right? If your portfolio or your specialty is that you go out and buy highly valued blue chip dividend stocks, heck yeah, good for you. But that doesn't mean that that same mentality can carry over to how you invest in and hold cryptocurrencies. You have to do some research. You have to understand what things mean. The same way that I look at level 2 quotes for equities is the same way I look at blockchain data for Bitcoin. So I want to have a quick video about this today. I very rarely put these out on Sundays, but I just keep seeing all this news come out, and there's this feeling of like every 5 minutes another major thing happens. And it's good, it's bad, it's terrible, it's the worst, it's great again, it's terrible. And I just think about the amount of people who have really spent time, they've worked really hard for their money, they're putting into this space, and then they're getting completely wiped out. It's absolutely the saddest thing in the world. I remember this happening big when retail forex trading really came into the US, and especially during the days of the overnight carry trade. The carry trade, the quick 30 seconds on this, is the idea that you essentially borrow one currency with a really low interest rate, and then you essentially lend it at a really high interest rate. You make the difference between those interest rates. Now, because of that 200-to-1 leverage, that little interest rate differential becomes a really big amount of money, potentially, right? But what happened was more people piled in, and then more people piled, and then more people piled in. And by the time they hit peak pricing, when it crashed, it just absolutely crashed and burned. And it feels so similar to what's going on here. And a lot of similarities I'm seeing is exactly as I just described. We have people who are lending out crypto. We have people who are on highly leveraged positions on crypto. And I think that this has happened before. It's going to happen again. And it's going to continue to happen because people want to find ways to make a lot of money with a little money in a really short amount of time. This means leverage, and this means high rates. So just if you're going to do anything, and I really don't, I'm going to say it again, I really don't suggest anyone ever leverage a cryptocurrency, but I get it. If you're going to do it, you absolutely must understand correlations between assets. You have to understand how they move in and against each other is what that means. And you also have to understand downside risk, what you're willing to lose, and set some stops. You cannot get blown up. The other thing as well, not that I want to make this all about this piece of it, the other big piece as well is people who are very successful in the realm of highly leveraged trading in equities always have cash positions available or easily accessed so that they can cover if they have to. Now, of course, realistically, it should never, ever get there because you should be hedged against it. You should have downside protection in place. However, at an absolute minimum, you should have the capital to cover calls if they come in, especially if you have something that you really believe in. I, for one, just as a perfect correlation to this, I absolutely think blockchain is an unbelievable technology. I think the projects that are being built on Ethereum, I think what is going on in the marketplace is absolutely amazing. But do I think that I want to approach it as a highly speculative, highly leveraged class of assets? I do not. I don't ever plan to. What I will tell you is, again, I am not your financial advisor in any aspect or way, and I'm not giving you investment advice here. Myself, personally, making these videos, I see prices start to drop like this, and I'm taking little bites out of the market, picking up the different things I like here little by little. What I will tell you is, and this is different than a lot of other folks, I really don't have a super diverse crypto portfolio. I don't really want that. I primarily stick with a very, very small handful, or even less than a handful, frankly, of what I like. I have a thesis for why I like it. I stick with it because I can see the value long term. I've seen it since the beginning days of this space. So with that, I just want to end on this note. You have to do more than 30 seconds of research before you dump tons of money multiplied by tons of leverage that can wipe you out in a second. You just have to do it. It happened in the mortgage markets. It happened in the dot-com boom. It happened in financial instruments and currency. And it just happened to cryptocurrency. It is going to keep happening. And the one final thing is the idea of market manipulation is not as complex as people think. As people think it is. A lot of times in unregulated markets like cryptocurrency, someone can come out and put a tweet, a Reddit post, whatever, a YouTube video, anything, and say, hey, I think crypto coin XYZ is going to hit some crazy high dollar amount or some crazy low dollar amount. Now they post that ahead of time. The reason you post ahead of time is now it becomes a historical reference point they're going to come back and point to say, hey, I know something that you don't. That's how manipulation begins a lot of times. Now, because there is an effort to control the market in some way in the back end, when that event does happen, they can go out and say, oh my God, look at this. I called this event a day ago, 2 days ago, 5 hours before it happened, whatever. So now the next time they make a post about a directionality or pricing of a product, people are going to start to listen and say, well, they were right the last time. I absolutely have to listen. You have no idea what positions or trade they have in place to go against you, right? Because you don't make money when everyone's trying to make money. You make money when you take contrarian positions against the market and then you make them swing into your direction. So just be really hyper aware that if you can't validate where your information is coming from by looking at real data, and this is the actual research work that you have to do, like be it, how many miners are using clean energy. Go and find out. It's not that hard to find that out, right? Look at the blockchain data and understand what's happening from the wallets and the hodlers and the whales and the retail traders. Look at it. Start to understand what borrowing and interest rates are. See if you can get information in and around how much money is leveraged. Then when you see posts and you think like, hey, this is an indicator, excuse me, this is an indicator that I might want to pay attention to, it doesn't become the thesis for why you put all of your money in it. It becomes one of many indicators that you build out your idea on so that idea can be the baseline for how you invest. But any good investor and long-term position holder knows even the best ideas can change on a dime, and you can't be married to an idea no matter how much you love it unless you're prepared to lose it. And the way you stop yourself from losing it is ensuring you have stop gaps throughout the entire position. So, hey, I hope you made it through the whole video. This was way longer than I originally thought I was going to talk about it, but I actually just I honestly feel really strongly here as I'm watching people get blown up because I lived it in 01, I lived it in 08, I started across multiple asset classes. I cannot believe I'm seeing so many people get blown up again. And it's all really around this idea of trying to chase big money as fast as possible. I heard someone say this the other day, and I'll end on this one. I was referencing to someone that, if I can get into a really good position right now where pricing is, and it just got back to where it was, that's like doubling your money essentially. He said, geez, what, all you want to do is double your money. And I was like, oh my gosh, like what has happened to the world? The idea of, doubling your money is now something that's like not good enough or not a good way to invest. Just stop it. Like if you can make 8 to 12% a year in the markets and consistently hold that, you're going to be really, really wealthy. You can retire really well. If you can get a small wins here and there that look like crypto size wins, that is just going to accelerate that growth. If you're only chasing 1000x, I have no beef with you doing that, but just know you can lose a lot of money if you borrow money to do it. So anyways, a little bit of a ramble. I have really been following this closely. I watch all that blockchain data constantly. I will say I do have a background in data and analytics and really machine learning as well. So I approach things very analytically by my nature, but truly I'm more of a fundamental trader. What I'm looking to do is fill the chasm that sits between those two processes and start to understand the directionality of it. So anyways, with that, thanks so much for watching. I hope you got some value out of this. If there are things that you think would be better or you would like to see covered or that you haven't seen covered in a way that would make sense, let me know. I can go pretty deep on a lot of different topic areas here, especially from the analysis perspective of the different asset classes. So, again, hopefully you watched it. Hopefully you got this far in the video. And otherwise, have a great Sunday. Talk soon.